Let's give you the markets update now. And the local index and the rand remain under pressure in early trade. This is after miners and retailers pulled the JSE lower yesterday. The markets closed in the red yesterday, weighed down by losses in miners and food producers. The South African rand weakening against the US dollar. Well, for an update now, let's get a sense of how things are shaping up at the JSE. Jimmy Moyaha is an independent markets analyst. Jimmy, good morning to you and thank you for your time, sir. Let's start with that quick overview of how local trade, including the currency, are faring this morning.
Morning, Tony. Morning to the viewers. The currency is still faring a little weaker. I think the most interesting thing around the equity markets is the fact that the last time you and I spoke, we hadn't yet concluded the month. So the month of September closed out of a trading range we had been in for the entire year, and it closed out to the downside. So from where we're standing at the moment on the top 40, it is a very slippery slope down to 60,000 points. We're currently at about 64,000. 700 odd points, but it's a very slippery slope down to 60,000 points, and there doesn't seem to be much support for the local bourse all the way down to those levels. That being said, the bourse opened down 2/3% on the all share side, about 0.5% in the red on the top 40, largely being led by financial stocks down currently about almost a full percent. If we look at the overnight movements from the US and into Asian session, the Dow Jones, the S&P, and the Nasdaq were all in the red for by more than a percent rather, and that filtered through to Asian sentiment, with Tokyo down about 2.2%, with Hong Kong down 1.1%, and Sydney down at just under a percent. On the currency side of it, the rand back at 19 rand 37. We saw briefly during the month of September that we managed to get back to that 19 rand level, even as low as 18 rand 70 at one stage, but we're back at 19 rand 37 against the dollar. Not looking good for the month of October, against the pound and the euro, also giving up some ground there, back above 20 rand against the euro. On the commodity side, the oil price sitting at about $90 a barrel. A couple of things that might be worth noting on that price as we look to the remainder of the year. Gold price sitting at $1,820 an ounce, critically approaching a $1,800 an ounce support level, and we've seen that gold has been on a steady decline. This is the third consecutive month of declines. We saw the previous 2 months about a 1% and about a 2 or 3% decline last month, and we're currently down about 1.5% for this month. So it'll be interesting to see how the rest of the month unfolds. It is still quite early in the month, of course. A couple of trading days have happened, or only 2 or 3 trading days thus far, but by all accounts, sentiment seems to be pointing towards a very different close to the year than what we started the year on.
Let's pick up on oil, Jimmy, steadying ahead of the OPEC Plus review of the global crude oil market, and, of course, the weekly update of the US stockpiles. Help us make sense of those moves, keeping in mind the steep hikes we are experiencing here or waking up to in South Africa today.
Yeah, so the oil price at the moment is currently sitting, as I said, just around that $90 a barrel level, and ordinarily you'd think that that is a stable price, and that's a good price for us. But if you look at some of the data points that came out, as you mentioned earlier, the stockpiles data that came out yesterday suggests that there's an increase in demand or an increase in usage in oil at the moment. We've seen refineries have taken up all of the oil in this time to refine it and create those fuels, anticipating what might come in the future, and that significant move on the stockpile side of it has resulted in what we could potentially see as a bullish move on the oil price. I think there's crude oil inventories out of the US later today, and so that data point is going to be quite important to look at when we look at the crude oil inventories, the crude oil imports, and all the other oil data points that come out of the US at about 4:30 this afternoon, because that'll speak to the stockpile data that came out yesterday. So significant decrease in stockpile coupled with say an inventory number that comes in lower than expected could point to the fact that demand is picking up, whereas supply isn't matching it on the U.S. side of things, and that could then drive the oil price a lot higher than where we expect. We know, of course, that the OPEC bloc is very keen to keep a control over that oil price, and they've announced supply cuts through to the end of the year. And so they're also watching these data points to say, what do these stockpiles look like in the U.S.? What does production look like in the U.S.? What do inventories look like? Are they replenishing stockpiles at the same rate or at a faster rate than they are consuming them? If not, that could create a bit of a demand side problem, and that could spur the oil price higher. So even though those stockpile numbers coming in much lower than expected, which is a positive sign showing that they are being used, it's not necessarily a positive thing for the oil price.
Let's talk about the Competition Tribunal, which has questioned a proposed antitrust settlement. And this is the agreement between the Competition Commission and Unilever. What's going on there?
If you remember, there was a settlement reached around 2017 or so regarding the Competition Commission's rulings and the practices of Unilever back then. And so I think it was to the tune of, there was an administrative penalty to the tune of 16 million rand. And so that is what is being contested at this stage. At the moment, it looks as though that, despite the fact that there was that settlement agreement, that Unilever agreed to, I think it was on probably about a product range worth of 340 plus million rand. Despite that settlement agreement being reached at this stage, there's questions around, or questions at least from the tribunal side, as to the agreement itself, the representatives that were there in negotiating this settlement agreement and those sorts of things. So we'll probably know more as we get details around what the next steps are in the event that the settlement agreement is to be reviewed or placed under review. But at this stage, it relates to a matter that took place back in 2017.
Let's conclude the conversation with markets, or should I say the company news. Sibanye-Stillwater's market valuation taking a pounding as the share price slumped as much as 9.2% in its biggest one-day fall in 5 months. And this is after the Morgan Stanley downgraded the already bitten down stock. Talk us through those developments.
Yeah, so Morgan Stanley basically came out with a comment, or with the opinion that they are not convinced that Sibanye will have another cycle like it had from, I think it was a couple of years leading up to 2013. Well, for a period, there was a period of time where Sibanye had a significant uptick in its businesses. They were diversifying their operations, acquiring new businesses and those sorts of things, and that led to a very prosperous time in their sort of trading period. We know that the recent commodity super cycle is very beneficial for them as well, with elevated platinum pricing and that sort of thing. And we've since seen that the PGM stocks have come under a lot of pressure, and Sibanye, where they've differed from other PGM miners and other gold miners, is they've continued their efforts to diversify. And so, I mean, that's extended to the extent that they're now looking at acquiring a copper mine in Zambia. So they had a couple of deals that did fall through in the last couple of years. There was a nickel mine in Brazil nickel or copper mine in Brazil they weren't able to acquire. There were a couple of deals that they had been working on, and Morgan Stanley's downgrade has come off the back of the fact that they don't anticipate that growth will continue for the coming period or coming couple of years, and they anticipate that the continued pressure on PGM mining stocks and pressure on other areas of Sibanye will prevent it from being able to meet some of it. Well, not necessarily prevent it from being able to meet its commitments, but will place a lot more pressure on its debt ratios, as well as on its ability to pay out dividends to its shareholders. Now, Sibanye still is a very, very strong business. They still have a healthy balance sheet. They still have a lot of capital available to deploy. I think the concern from Morgan Stanley's perspective is the fact that if they do not deploy that and they do not increase their revenues and their incomes, given the pressure that all PGM miners are under, that could potentially affect some of their performance or some of their returns in the short to medium term. If you look at the Sibanye stock, though, share price is sitting at about 26 Rand a share. We we have looked at the share price in the past and said that there is the potential to come all the way back down to 22 Rand a share. The company itself is still making its play on the battery metals space. We know they've got lithium operations in the US and in Finland. We know, as I mentioned, the copper operations that could potentially come out of Zambia. So they are still very much on the diversification bandwagon and focusing on battery metals with the view of aligning themselves for the future. So you could continue to see that at the current demand levels, the share price might be under pressure. But if those demand levels suddenly uptick overnight, then Sibanye would be one of the better placed mining companies. So I guess it depends on your long-term viewpoint on the share and what your long-term viewpoints are with regards to your portfolio as to whether or not you agree with what Morgan Stanley says.
Independent markets analyst Jimmy Moyaha, thank you very much for that markets update.